Hello, good morning and good afternoon to all your attendees. Thank you for joining us this morning from Asia. My name is Angela and I'm the programmer for this meeting. And we are delighted that you are able to join us on the ONFIF Global Public Pension Report launch today. And just a quick reminder that this meeting is on the record and there will be a video playback on our website and YouTube as well. And without further ado, I want to hand it over to Mark Burgess to give his welcoming remarks. Over to you, Mark.
Thanks very much, Angela. Hi, I'm Mark Burgess. I'm chairman of ONFIF in Asia, but I'm also heavily involved in the asset management business, having previously been the CEO of the Future Fund, Australia's sovereign wealth fund, and now I'm involved chairing investment committees for large pension plans here in Australia, as well as the work we do at ONFIF. Thanks for joining us today. As all of you would be aware, ONFIF is very, very focused on the intersection between the role of financial markets, the role of policy, central banking, and also the role of asset owners and how that interacts. And as I'm sure everyone on this call is focused on, we're at a very, very interesting time for the management of money and the management of assets on behalf of all of our stakeholders. We're also here to launch today the Global Public Pensions 2020 report. It's our first, and I'd just like to thank Citi and Capital Group for their support in the work on this publication. As you know from the topic today, one of the great issues for us as we recover from the COVID environment, and we will recover at some point, is the role of pension assets and large asset owners in that recovery process. It also comes at a time when we've had 35 years of declining interest rates. And often I help university students out and they ask them about my career. And really my career has helped over that entire period surf the wave of falling interest rates, which has helped lift all boats, lift asset prices and help support us as investors. Well, as we all know, we're at a very critical moment for the allocation of capital because interest rates are already low, returns are hard to find, while we still have very significant demographic profiles which will increase savings as people look to retire. But we also have demographic profiles that will make economic growth difficult. So it is a combination that is a real test of skill, a real test for asset owners and the way they approach investing. But I think we also have an additional moral obligation, I guess could be the word, or at least an obligation to help support our communities. It's often forgotten that while we look to chase returns, we're also in the process of allocating capital, and good allocations of capital can do things for economic growth and for the environment and for the people around us. And so on today's topic, some of the discussions will be around issues, for example, such as ESG, sustainable investing, and that next iteration, which is so important for the allocation of capital. I'd like to welcome Marsha Vandenberg, who's a senior advisor here at ONFIF, who will be chairing the panel. And Marsha comes with terrific experience, having been part of our industry for many years, including working with some of the brightest and smartest global pension plans. And so Marsha will guide us through our panel. On the panel today, we have representatives from Citi and from Capital Group, who are both, as you know, allocators of capitals themselves, but also we have representatives from the pension schemes in Thailand, in California, and here in Australia. So I'd like to thank all the panelists for joining us. Before we do the panel, though, we're just going to show a video which talks about the highlights of the Global Pensions Report. The report is available. Feel free to come to ONFIF for that. And again, I just like, as I sign off, to thank all of our supporters who help the work with ONFIF. I can't emphasize how critical this intersection between policy, the intersection between financial markets and those of asset owners is going to be. We know there's a lot of policy intervention at present. We know it's having influence on financial markets, and we know that you need to have knowledge and insight on these issues if you're going to allocate capital well. And hopefully ONFIF can be part of that process for you. So I'll now hand over to a video that's been put together by our economics team in London that gives you a kind of a sense for what the report has identified, and it gives you a sense for what is in the report. But of course, feel free to get a copy and have a read yourself. So Angelia, if you could just give us the video, and then we'll have the panel straight after that.
Hello, everyone, and thank you for joining us at the launch of our inaugural Global Public Pensions Report. This is a report that has been in the works for quite a while, and I'm happy to be here today to share some of the key findings with you before handing over the stage to our stellar set of panelists. So let me start out by giving an overview of what I mean by global public pensions. So this is an institution type that we've covered as part of our Global Public Investor Report. But as Figure 1 on the left-hand side shows you, public pension funds are by far the largest of the three institution types, being more than twice as large by total assets as sovereign funds, and significantly larger and more, shall we say, exotic investors than central banks, who are next at just above 14 trillion in assets. And as you can see on the right-hand side, these global public pension assets are quite skewed towards North America. So as you see, based on our sample that we cover as part of the GPI, US public pensions hold over 7 trillion in assets, with Canadian public pensions also close to 2 trillion. So they really make up the bulk of public pension fund assets. Japan as well is second in this ranking, with GPIF making up a large chunk of the space. And then you have other sort of classic pensions markets like the Netherlands, South Korea, and the UK. So that's kind of a quantitative overview of this investor group. And then I want to lay out two of the key challenges, two of the key trends that public pensions are facing, and how they tie into the findings of our data aggregation exercise that we've conducted as part of this report. So as you can see, these two charts show a sort of a pair of trends that have been of key concern to public pension funds. On the left-hand side, you have the overwhelming decline in fertility rates since the baby boom, and on the right-hand side, you have the trend of increasing life expectancy in developed economies. So together, these two trends combine to make it such that public pension funds are facing increased liabilities as their retirees live longer. And so that's not quite matched by the corresponding base of contributors who are presently contributing to support the retirees. So another way of thinking about this is in terms of the old age dependency ratio. That has been growing as well in recent decades. So these demographic trends are combining to place pressure on pension fund funding ratios. The other key challenge that I'd like to walk you through is, I think we're all familiar with this trend, is sort of the decline in government bond and generally in fixed income yields on the left-hand side, government bond yields in select jurisdictions. In some of the largest public pension markets, you see they've declined precipitously since the turn of the millennium. And then on the right-hand side, you see a 10-year U.S. Treasury index in dark blue, as well as a corporate bond index. So you see that those have not been providing the returns that they may have in the past. On the other hand, equities and things like real estate have been. Those are the two lines at the top. So the picture that comes from these two this pair of slides and these four charts is that pressure has been increasing on the demographic end as well as on the financial end, where public pension funds have been forced to kind of rethink their investment strategy. So this brings me to one of the first key findings that is visible in this database that we've put together as part of the GPP, and that has to do with actuarial assumptions. So as many of you will know, actuarial assumptions are those that are used to calculate the value of future liabilities by public pension funds. So these two trends about demographics and investment strategy crystallize in one of the main findings from the database that we've constructed as part of the GPP project, and that has to do with actuarial assumptions. So as many of you will know, actuarial assumptions are the figures that are used by public pensions to calculate the value of future liabilities, and those those typically are comprised of a set of demographic assumptions and a set of investment assumptions. And so, demographic assumptions, those include things like how long people are expected to live, how long retirees are expected to keep drawing on their pension pots, while on the other hand, the investment assumptions have to do with how much a pension fund expects the pool of assets to grow over a long time horizon. And it's important to get that right, because if actual returns undershoot the investment target, then that means that in the future contributors will have to contribute at greater rates in order to achieve a sustainable funding ratio. So it's about intergenerational equity, if you will, in some sense, balancing out who contributes how much to avoid undue pressure on future contributors or on governments in some cases. So as I showed you a couple of slides ago, returns have been declining, but it's not clear that the investment assumptions that pension funds use have been declining at a similar pace. So on the left-hand side, you see this for a set of jurisdictions. You see that in most jurisdictions, the real investment targets really haven't changed that much. So that means that public pension funds still expect to be able to achieve fairly similar long-term real rates of return as they have in the past. So this time series extends from 2015 to 2019, which isn't a gigantic time horizon, but the fact that things have remained roughly constant over this period is somewhat concerning. And then on the right-hand side, this is for a sample of U.S. public pensions specifically. So it shows that their nominal targets, so the discount rate really that they use to value future liabilities, has declined slightly. But this is mostly due to changing inflation assumptions or inflation expectations, as the average real rate of expected return has remained roughly constant. So expected real returns are still where they were in 2015. And so that seems, to some observers, that might seem like a sort of sanguine assessment of investment returns in the future, especially given now the prolonged low interest rate environment that many are expecting. So this brings me to the next key finding that I wanted to highlight. And it's a way of illustrating where public pension funds might seek to achieve their return targets. So what we've done is we've aggregated asset allocations as a share of total assets for a set of 100 public pension funds. These represent around 77% of total public pension assets globally. So as you can see, the main finding is that fixed income is probably a lower share than you'd expect, and that has a lower share than has historically been the case, while the public equity share across this sample is quite high. And it should be noted that given that we do this on a weighted average basis, some of the large US funds like the Military Retirement Fund, which invests only in US Treasuries, they'll kind of skew this. So for if we were to exclude those funds, the share of public equities would likely be even higher. And then the second point is about the high share of real assets in private equity. So at over 13% of total assets, that's quite a high figure, and might explain why pension funds expect to achieve high real returns over the coming decades. And then on the right-hand side, you see we've put together a time series of returns for these pension funds, and you see that they tend to vary quite a bit year to year. It's that might be driven by the high share of volatile public equity allocation. These tend to sort of swing up and down. I mean, as you see, the first quartile of returns, so the bottom quartile was down quite steeply in 2018, probably because of the equity slide in December 2018. So, but this kind of broad overview in Figure 9 shouldn't obscure regional idiosyncrasies, as we see on these slides, and this is illustrated in much greater detail in the report. There's a lot of difference between, say, a Canadian pension fund. Here on the left, you have the aggregated portfolio, the weighted average for Canadian funds, and as you can see, it's kind of a vindication of what people often call the Canadian model, with a high allocation to real assets and private equity. Whereas on the right-hand side, you see that on average, Australian funds tend to invest in listed equities to a far greater degree as a share of total assets. The share of other assets in that Australian average is quite high because a lot of annual financial reports don't really break down their pooled investment vehicles, so those might be invested in equities or in fixed income products. But where a breakdown wasn't available, we aggregate that into the other category. But it's quite clear that listed equities make up a greater share of the Australian portfolio of the Australian total asset holdings. So this is explored in greater detail in the report, where we slice it a number of different ways. We also feature a spotlight on private equity allocations, where, on the left-hand side, you can see again, Canadian funds and North American funds generally have the highest allocation to private equity as a share of total assets. I think that's not unexpected, but again, this is sliced in different ways in the report, and we also explore some of the possible rationales behind these high allocations. One of those rationales obviously is on the right-hand side, where you see returns on private equity assets over different time horizons. One of the takeaways for me that we highlight is that U.S. private equity tends to perform the global average, tends to outperform the global average over all of the time horizons illustrated here. So that is both one reason why U.S. private equity is so popular and may provide an indication of where future market moves might take place. And so as a final point, we also, we highlighted the growing share of listed equities that are held by public pension fund portfolios, and those holdings often come with greater responsibilities, especially as conceptions of stewardship and of what it means to have a fiduciary relationship with someone. Our understandings of those terms have evolved over the past few years quite significantly. And so in order to explore that theme a little bit more, we devote one chapter to corporate governance issues and how public pension funds have grappled with that, and with how to promote good governance in the companies in which they own shares. So as you can see, we sort of try to illustrate activity, and we explore why so on the left-hand side in that chart, you see the number of proposals filed by U.S., state, local, and federal funds at Fortune 250 companies on say on pay or executive compensation issues. So this is data from Proxy Monitor, and as you can see, activity sort of declined quite steeply after 2010. But I think one of the takeaways from this is that given that there's increasing pressure on these large asset owners, public pension funds, to promote good governance, I think we're likely to see an uptick in activity there. And on the right-hand side, we have just wanted to highlight an external contribution that we have in the report from GPIF, obviously the largest public pension fund according to our rankings. They're obviously a large equity owner, and they've been at the forefront of a lot of thinking around what it means to be a responsible asset owner and what stewardship means. So we wanted to sort of showcase their thinking of this, and they've kindly contributed to the report. So that concludes the presentation. So I've highlighted some of the main takeaways from our database, where we have collated asset allocations, a time series on returns, and some of the actuarial assumptions that pension funds use in conducting valuations. I'm happy to answer any questions via email, both about the presentation, about the database, or about the report. So feel free to get in touch, and thank you for attending our launch.
Okay, well, thank you very much. I learned a great deal. I'm going to ask my panelists to join me as well, and we'll get started. I hope you can forgive that little blip with technology. It happens to the best of us. It's pretty remarkable that we can assemble this many people from so many different parts of the world and end up with a discussion. So here we're all coming online. I guess I'm waiting on a couple of more. Ann Simpson is there, and I think Deep is coming on. Okay, well let's get started. My name is Marsha Vandenberg, and I'm an advisor and on the advisory board of OMFIF. Delighted, it's a pleasure to be doing that. I want to say first a big thank you to the 100+ listeners and viewers who are in our webcast audience. We're very glad you are where you are, listening to us in Singapore, San Francisco, Melbourne, and London. Public pensions, as we've just heard and as we know, are the lifeblood of millions and millions of retirees, yet their funding is dependent on a number of variables, both domestic and global, short and long-term, risks that can be seen and risks that aren't contemplated, like COVID-19. This OMFIF's inaugural Global Public Pension 2020 report is a massive effort through interviews with executives with some 100 pension plans worldwide in an effort to put a finger on the challenges and the crucial challenges that face managers who are today responsible for some 17 trillion in assets under management, and then to provide forums like this one where experts can come together, share what they see, share what they know, and provide ideas for pathways forward. In today's session, which originates in Singapore's, in OMFIF's Singapore's offices, we're going to talk about the implications of these trends that we've just been briefed about with a panel of experts who represent asset owners and asset managers in Asia and in the US. Our session follows a similar webcast, as you heard earlier today, earlier for me in San Francisco, during which the key challenges highlighted by the report were laid out, just as we are about to discuss those same challenges, but from a decided Asia focus. I have a truly stellar panel. It's a pleasure to be with each of these people and all of them collectively. I'll introduce them in order I'm asking each to speak, and we'll go from there. So Dr. Man Judajudata is the Deputy Secretary General of the Government Pension Fund in Thailand. Ann Simpson is Managing Investment Director with major responsibility for governance and sustainability. Robert Crossley is Head of Business Advisory Services for Citi with responsibilities for Europe and Asia. He's calling in from London. Andy Budden, an investment director at the Capital Group and based in Singapore. And last but not least, of course, is Deep Kapoor, Professor Kapoor, who is a member of the Board Investment Committee of the Retail Employees Superannuation Trust in Melbourne and a professor at Monash Business School, also in Melbourne. We'll take your questions in the meanwhile while we're talking. So please post them in the chat. I'll try to catch them as they come in. Angelia with OMFIF will also do the same, and we'll try to get to as many of them as we can. So there's our lineup. Let's get started with Dr. Mann, if I could. The report, GPP for short, highlights many of the pressure points facing pension managers like yourself and spotlights in particular asset allocation and risk mitigation as two primary issues, as two central concerns. How are you sizing up the investment landscape in light of those pressures from where you sit in Bangkok? Dr. Mann.
Hello, good morning, everyone. Yeah, we see that it's going to be some extended period of time for fatter return for years to come ahead. So if we maintain our strategic asset allocation as if we had now, I mean, the risk is going to increase and the return going to reduce. So what we do now is we have 4 choices. First one is we have to take more risk. It means that we have to take more growth asset more. So right now we move up very near to the limit. We have limit of 40% risky asset. So now we have around 38% already. Yeah, we move near to the limit. And the second option is to trade off between risk return. We see that fixed income going to yield very, very low, and equity, they are much more volatile. So we switch into alternative asset, which is private equity, infrastructure, and real estate more. 5 years ago, we have only 5%. Now we explore to around 13%, 14%, and we expect to have more, nearly 20% in the near future. So that's why we shift allocation to the alternative investment. And I think the third thing is we do more dynamic allocation. We don't fix at a long-term strategic allocation, but we have a medium-term where we can move. We have a deviation range plus to minus 7% equity into the portfolio to match the economic cycle. And we also have a short-term tactical asset allocation as well. We set a risk budget for active management is around 15 to 20% of the total absolute risk to the total portfolio. And we also have we plan to have a FX as another asset class. Yeah. And the last one is we try to expand the limit of the investment. Right now, the Minister of Finance allow us to do foreign investment from 30% to 40% already. So we have more room to flexible manage our portfolio. Yeah, I mean that's 4 things that we are move forward into asset allocation.
Okay, terrific. We might come back to you on the question of risk, Dr. Mann, but let's go to Anne, because Dr. Mann is describing a great deal of diversification in his allocation. You're with Calpers, the biggest fund in the US, very diversified. And I might also add one of the leaders in sustainability, and yourself are a leader, and your fund is a leader, of course. But if you might talk a little bit about how Calpers is approaching that same asset allocation question. Dr. Mann is talking about increasing their public equities, increasing their private equity by quite a big jump. So what is Calpers doing?
Well, first of all, thank you so much for including me on the program, and many congratulations to, I've never thought of you being called OMFIF. I've always thought of you as the OMFIF, but OMFIF, it's a magisterial report. It's an extraordinary range, and I really think you capture so much of the important trends and the issues that we're all dealing with in the defined benefit pension funds, the public pension funds around the world. So it's a great honor to be here. It's also a personal pleasure because I've known David Marsh, your founder and chairman, I think for 30 years, which is a bit of, there's a long-term perspective for you from when we were both in London. So it's a personal pleasure, not just a professional privilege to be joining you. So let me just set the scene with Calpers. We are, Martha, as you rightly said, the largest public pension fund in the United States. So we have something north of $400 billion in assets. We have nearly 2 million members. And I think the point was made very nicely in the beginning, in the opening section, that pension funds are not only extremely important for the beneficiaries because they're providing benefits, in our case for retirement, but also Calpers is the second biggest purchaser of healthcare in the United States. So healthcare and retirement, these are all very, very important to the social fabric of society. However, for every dollar that we pay out in benefits, almost 60 cents, excuse me, comes from investments. So that means all of the millions of working people and families in all of our countries are relying on the financial system to function well. and have an immediate interest in capital markets stability, safety, and soundness. So perhaps these topics once upon a time were rather remote, but now they're vitally important to so many. So the point about our local impact is as follows. We pay out our current liabilities, we pay out around $25 billion a year in cash benefits. That's every month. And we've actually modeled some of the economic multiplier effect of that into the California economy, and it's substantial. But there's more. We are also vitally important for the employers, not just because we're providing benefits to their workforce, to the judges, the firefighters, the janitors, all the public servants in California, but those employers are on the hook for the gap between the contributions and the investment returns. And that's where Calpers is in a very similar situation to many other public funds in the United States, at being around 70% funded. So at our most recent discussion on how are we going to move towards the target 7% rate of return that we have, you can find all this material on our website. There are a number of considerations. The first is risk, as has been rightly mentioned. And for Calpers, we say there are three main risks to our system. One is achieving the required rate of return, or the sought after rate of return. Two is our employer's ability to pay. And this is an economic knock-on effect right now from the COVID crisis. You can look at communities and businesses up and down California, which have been hit very hard. I mean, think what happens when Disney World shuts down for months on an end. The small business, the restaurants, the hotels, the taxi drivers, everyone providing hamburgers and tomato ketchup and chips and everything in between. There is a whole sort of economic impact that rolls out when big employers can't function. The other big risk that we highlight is climate change. Now, that is a risk when you're our size that you can't fully diversify out of. And I think it was a lesson that we all learned through the 08-09 crisis, which is, risk ain't what it used to be. And what we did at Calpers was develop for the first time a set of investment beliefs which capture a concept of sustainability, which is now embedded in our investment strategy. And there are a couple of ideas in that which I think are very relevant to this discussion of risk. The first is that we said risk for Calpers is multifaceted, and it can't be fully captured through the traditional measures like volatility or tracking error. And we call out issues like demographic change, climate change even. And on the return side of the equation, we say that long-term value creation relies on the effective management, not just of one form of capital, financial capital, but three forms of capital. So financial capital, yes, that's our day job as investors, but that needs to be effectively managed in conjunction with human capital and physical capital. So that gives us a deep interest as fiduciaries in what's happening with the workforce, with issues like diversity and inclusion. I can say more about that particular theme if you're interested. It's very relevant in the middle of the COVID crisis. But on physical capital, we identified climate change as the issue. And we came to this through quite an extensive research program called the Sustainable Investment Research Initiative, or affectionately known as SIRI for short, although this was before Apple chose that as the name for the robot on the phones that you might be familiar with. But these were research reviews which were conducted on our behalf by academic teams, because we really wanted to identify what were the sources of risk, what were the drivers of return that we weren't capturing in our traditional financial analysis. And that highlighted a number of issues. One was the need to have some significant upgrade on data and corporate reporting, because one of the main problems in that exercise is that we simply don't have the data, and corporate reporting has not caught up with 21st century economics. And so we've been very active in the regulatory arena, calling for corporate reporting to begin capturing these issues. A second cross-cutting theme for us was climate change. And we said on that, we're called often, by NGOs to say, sell your shares, sell your shares in the oil industry. That's what we want you to do. Well, actually, when we sell our shares, it just means someone else buys them. It doesn't actually lead to the transition of the business, which is what we really need. So that track of work led us to convene meetings with our fellow asset owners 3 years ago, in which we looked at an extraordinary finding from the research exercise, which showed that of our 10,000 companies in the portfolio in public markets, less than 100 were responsible for the majority of the emissions. So this was an extraordinary concentration of source of emissions. And that was the beginning of Climate Action 100 Plus. And what we're doing there is using the power of ownership, working in common cause with other asset managers and other asset owners to ask these companies to do 3 things. One, for the board of directors to take responsibility for developing a strategy and getting their compensation arrangements lined up and their political lobbying lined up with that. 2, to set a target to bring those companies' emissions down in line with what's compatible with a global warming target of net zero by 2050, which is very demanding, and all praise to recent initiatives in Asia from China, Japan, South Korea, which, where governments are starting to really understand they have to set these targets, and that helps the business sector come along. And then the third thing we're asking for is disclosure, back to the importance of data and corporate reporting. So we're strong supporters of the TCFD framework that came out of the Financial Stability Board stable when Mark Carney was the chair there, because that gave a framework for reporting. So the good news is this initiative shows that when asset owners and their managers can overcome the tragedy of the commons, if you like, in that diversification leaves you with a tragedy of the commons because no single owner can take responsibility for an outcome. It's enabling us to actually drive change. And we're having significant numbers, I think over 50 now, of that group of companies which have made that net zero 2050 commitment. And that includes cement companies, steel companies, companies in the agricultural chain, utilities, transport, aviation. In other words, we have to not just be focused on oil and gas companies. We have to look at energy right through our portfolio. So we've extended that strategy into our other asset classes, and I'll be happy to say more about it. In terms of the 7%, we have, our board has adopted a strategy which we call towards 7%. This investment is all about allocating into uncertainty. And as Yogi Berra, that wonderful baseball player, and noted, quipped once, the future ain't what it used to be. So now we've got to think about allocating capital into uncertainty, which is exacerbated by issues like climate change. So we have, we're doing the same carbon footprinting process across our other public and private asset classes, and also developing some new tools like a new physical risk modeling framework, which helps us tackle what we're calling zip code risk, so that we can actually look at whether we're being rewarded for the risks that we're taking with physical assets that might be subject to sea level rise, extreme heat, wildfires, and so forth. And alongside this, our strategy for increasing returns includes increasing our allocation to private equity. I mean, many of you will have perhaps seen this because all the Calpers board meetings are available on YouTube for the insomniacs out there among you who like to hear more. A modest application of leverage, and also ours entering into new arenas like private credit. So what we think with this mix of measures is that we're improving our odds of achieving that 7% rate of return, but mindful that, yes, the future ain't what it used to be, and we've got to be able to manage through the climate change risk and find the opportunities that are there. And of course, in the short term with the pandemic, we've also got to be able to support businesses and help them as they deal with the brutal impact on the economics of their business, but also on their workforces and their communities, and then of course on the tax revenues for all the agencies which then pay into our pension fund. So we really have to take a holistic approach. We're still focused on the long term, but as you rightly said at the beginning, Marsha, you've got to be able to, walk and chew gum. In a pension fund, you've got to be able to focus on that long-term growth, but in our case, we also have to continue to generate significant amounts of cash to pay those benefits that put food on the table and pay the rent for our members every month.
I can recall being in the office at Calpers visiting with Anne and the CEO of Calpers, and on Marcy Frost's desk is a paddle, a chalkboard paddle, where she writes where the funding status is, I think on a daily basis. Anyway, Anne, that's a very rich program that you have, and I'd be interested in coming back and asking if you've given any thought, which I'm guessing you have, on how you measure the impact of sustainability's contribution to the overall effort. But let's go to Robert next, if we can. Robert, you do an annual survey at Citi, in your group at Citi, where you talk to, interview, survey a number of asset managers and intermediaries about the direction of markets and the direction of investments. What are you seeing both in the West but particularly in Asia around some of the issues that Dr. Mann raised, some of the issues that Anne raised, like sustainability's contribution, and Dr. Mann on asset allocation that was also mentioned by Anne. What are you seeing in terms of direction of the landscape as it's taking shape in this COVID era and all the rest?
Thank you very much, Marsha. Indeed, we do. We each year, or probably every 6 months or so, we interview between sort of 30 and 50 trillion of investors, managers, and intermediaries. And I think two things really emerge. One related to how capital has been allocated, and the other related to how the pandemic may actually accelerate a change in how retirements are provided for. So the first point, I think, is that the pandemic has really changed the perception of ESG risks. It's lengthened investment horizons, it's broadened the range of risks being considered, and that's narrowing the gap between asset owners who've always been focused on responsible asset ownership and asset managers who've been traditionally focused on responsible asset selection. And so we think some of those ESG aware capital flows that Anne talked about we strongly believe they will increase as investment managers are forced to adapt and widen the scope of the risks they address. And at the same time, I think the other thing that's come out of COVID for us is that it's radically reduced government's ability to spend money on anything, including supporting workers in their retirement wherever they are, not just in Asia. And I think that's, and I know we're going to talk about demographics a little bit later, but I think just for now, I think that's particularly important, because when you look at the middle class growing by whatever it is, 47% by 2030, and China having 80% of the, so 85% of the spending power of the US, and India having roughly the same, about 2/3, and you add to that picture the sort of over 65s in Asia growing by 55% in the next 10 years, whilst the support ratio falls, all that together means that it all points towards a shift in emphasis from public collective provision to individual private provision of retirement savings, and that isn't restricted to Asia, but it's most stark in Asia. And I remember sort of even before the crisis, sort of employment was becoming much more sporadic and income available for investment was becoming much more irregular. I think new savings models may be required to take account of both the growth of the gig economy and in the aftermath of the pandemic. So I remember listening to a senior executive at a large electronics hardware manufacturer, and this was 3 years before COVID. He was predicting that 40% of workers in Europe will be freelance by 2022. So whether that figure's higher or lower in Asia, as the, let's call it the gig economy grows, and as regular salary checks become either a distant memory or a distant prospect for large parts of the population, the investment industry will be forced to cater to the flow of savings, small and irregular flows instead of what they do today, which is cater to the stock of savings, the large pools of money and regular large contributions. And that has potential implications for managers and for pensions alike. And responding to your question about East and West, Marsha, I think the popular perception is that the East has, you might call it a long-term savings problem, and the West has a long-term savings problem, and the East has a long-term investment problem, being unwilling to risk short-term income in pursuit of long-term gain. I think whether that's true or not in some spheres, I think for institutional investors who are focused on that intergenerational wealth transfer or intra-generational wealth transfer that Pierre was talking about, long-term investors, in other words, they're similar the world over because they're forced to be. And the asset managers who help them manage that capital are similarly global in their perspectives and their operations. But I think the key point and the sort of key distinction between East and West is when you look at how much of that capital is managed internally by pensions and how much is externally managed, that's when the differences show up. So for instance, in Europe, public pensions who have in-house management capabilities, they manage about 85% of their AUM internally versus about 59 in APAC and about 55 in the US. And that arguably makes them much more specific and focused in their demands of those external managers. And so returning to one of Anne's points about sort of ESG as a whole, I think as a whole, European pensions tend to be further along the road as a broad generalization in thinking systematically about and directly managing those long-term risks that are not traditionally considered by shorter term financial markets, and especially not by secondary markets. So what I mean by that is the systemic risks, the stakeholder alignment risks, and the externalities. And pre-COVID, I think ESG was thought of by most managers, but not investors, as largely E-focused, because that's where the regulation has been, and G was really about risk avoidance. So ESG risks were thought of as long-term and by extension as slow motion. I think COVID dramatically and brutally showed the world the importance of S and the interrelated nature of our social and our financial systems, and that long-term doesn't mean the same as it never happening or that impact being gradual. And so tying all that together, I think what's happening is that's accelerating the move by some managers of thinking of ESG in terms of responsible asset selection, which is bottom up and largely exclusionary, to thinking in the terms outlined in terms of responsible asset ownership, which is much more holistic and also at the same time much more specific in its risk considerations. And so I think you can see how that has brought it's bringing asset managers in their perspective much closer to and in line with the long-term perspectives of pension funds and of sovereign wealth funds.
Okay. I wonder, just to bring it to a bottom line, Robert, because you started talking about the difference in individual savers and individual investors, and then you talked about the funds and then about ESG. If you could just in 2 or 3 points, key differences or key similarities, East to West, West to East, what would they be?
I probably think the one most important that we haven't mentioned is pension saving in the West is encouraged by tax policy, where taxes tend to be higher, a sweeping generalization. Without that tax impetus, there are fewer. The prospect of encouraging more private saving in the East seems more constricted. The second big difference I would say would be that in terms of the ESG thinking, and with obviously some very notable exceptions in North America, the ESG thinking both in the managers and in the sort of managers is more advanced, not the investors. And then I think thirdly, the way that the economy is, the way that when I was talking about the sort of gig economy and the sort of aftermath of the pandemic, I think that entails a very different interaction model with individual scheme members and savers, which may favor a digital scalable network system that's much more advanced in the East rather than the more traditional Western system that evolved in an analog age, essentially.
Mm-hmm. Well, let's come back on some of those points. Let me turn next to Andy, though. Andy, you've done at Capital Group a lot of thinking about what vehicles would make sense in the various markets of Asia, and it's pretty clear Asia is not homogenous under any stretch of the imagination. Just look at the demographic differences. But you've done a lot of thinking about what those vehicles would look like in light of what Robert is saying in terms of what's happening here in Asia, the demographic changes north to south, the less of a tradition to save and to not to save, but less of a tradition to invest than you might find in the West. What is your thinking about how you approach a market like that? Give us your insights and anything else you want to add to the mix. Go ahead.
Yeah, thanks. Thanks a lot, Marsha. And I'm going to come at this from, just to help everyone calibrate what I'm going to say, I'll come at it from the perspective of a large asset management company where a majority of the assets we manage is actually in retirement structures around the world. So that hopefully that just helps folks calibrate what I'm going to say. So, okay. The current situation, well, kind of stating the obvious, Asia is aging. Retirement provision across this rather heterogeneous region is, I would say, is not entirely adequate. Obviously, consistent with a global phenomenon. And I think the question then is, of course, how can we provide sustainable and adequate income for retirees? And I think if we look across those classic three pillars, so pillar one, state provision, unlikely to be the answer on its own anywhere in the world, but certainly that's probably not going to be that's true for Asia as well. So pillar one, state provision, unlikely to be the answer. Corporate retirement, so pillar two, well, in Asia ex Japan, actually this is unlikely to emerge in many markets, so obviously makes it a little bit different from the rest of the world. And then we have pillar three, private provision, and this is definitely kind of extending what Robert was saying. It is going to be increasingly important, so it's very much pillar one, pillar three exercise. And the problem we have in Asia is quite an intriguing one, because it's not so much the level of savings, but I believe it's actually the lack of suitable retirement savings vehicles. So we do have a high savings rate in Asia, but the way I would think about it is that the culture of long-term investing is weak. And so if we look at pillar one, so large kind of defined contribution plans, run by countries, I observe that in general they're either really quite conservative, or when they provide choice without adequate advice. And then we look at pillar three, so wealth management, and I just think there's a real question mark over the quality of investment advice there. It tends to be very short term, tends to be sales ideas. Frankly, it tends to be more financial entertainment, as opposed to focusing investors on the life goals and how to build a financial plan to achieve those life goals. And frankly, I think most investors are actually terrified of this. It's a very, very unapproachable proposition, and I think of it as really as an advice crisis. So how do we solve the advice crisis? Well, I could go down a number of paths, but I'm just going to pick one, which is actually retirement target date, which I think is probably going to be an important part of the answer. We're seeing a surprisingly large wave of target date cropping up across the region. And obviously in the US, since it became the default investment for corporate DC back in 2006, I think it was, it's captured a growing share of American corporate DC flows. And I just think we're in the early years of a wave of this in Asia. The poster child is probably Korea, which is gradually following the path of the US with target date as the default investment, actually in a corporate DC structure, although amazingly, most of the assets at the moment are actually coming from pillar three. So really interesting case study. Singapore is gradually moving towards using target date or something similar as part of the CPF investment scheme. Hong Kong has implemented, well, something slightly different, but somewhat related, a similar investment profile for part of the mandatory provident fund. And we've heard some rumblings of target date in both pillar one and pillar three in Thailand, actually Taiwan as well. And so I do think it's interesting just to think about, well, what is it about target date that makes it relevant for Asia? And I think it's because from the investor perspective, target date is aligned and visibly aligned with their real life investor objectives, which makes it approachable and actually also makes it very straightforward for them to access, because it's essentially a set and forget type arrangement. And also, whilst target date is very much pillar 2 in the US, innovation in Asia, as I've already said, is showing how target date can actually be much more than just pillar 2. It's also a pillar 1 and a pillar 3 thing, with Korea being the case study. And I think the final thing I'll say on this, Marsha, is that I think that target date can also be very helpful for investing during retirement. It gets so much more complicated when you move from accumulation into decumulation. It's much more complex, and target date is a little bit of a blunt instrument, but it can be a whole of life scheme which takes the investor all the way through their working life and through that very complicated investing during retirement phase of their life as well. Sorry, Marsha, I spoke over you there.
No, that's quite all right, Andy. But just quickly on the target date vehicle, are you finding that the interest, it correlates with more developed economies in Asia? Or are you finding that it's, you know, it's been successful, say South Korea, and therefore interest picks up in Taiwan, interest picks up in other places, Hong Kong, Singapore? Is there a kind of a spread that happens, or are you having to deal with each region individually unto itself?
So, I mean, two parts to a really quite short answer. The first one is that it has been amazing to see how the green shoots on target date are actually popping up in a number of markets in Asia, which are really quite different from one another. So I think just this concept of the fact that it's approachable, it resonates for investors and citizens because it relates to their life goals, and that set it and forget it. All of these things just have quite universal appeal, irrespective of the state of development of a particular country. The final thing I'd say is so does that mean you just build the Asia target date and it solves all problems for everyone? Well, no. I mean, clearly different countries have different legislation, different tax, different preferences for home bias, different existing schemes in place. So I think it requires a degree of adjustment for different markets. But I think it's a concept that appears to have legs and momentum.
Okay, terrific. So I'm going to come to deep, but before I do deep, I've got a question here for Robert. Let's just go ahead, and I want to encourage questions from the audience. Is there a difference in performance between public pension funds that are managed internally and those that are managed externally? And then we'll come to you, Deep. Robert, can you answer the question for our listener?
Sure. I don't know the answer to the question in terms of performance. I suspect that the answer, I know there's a difference in terms of cost and in different asset classes, and I've struggled to recall the numbers, but there's a really interesting study out there which has the difference in sort of internal and external management costs. I suspect that even if we did have the data, it wouldn't show us what we would actually want to see, because the type of management that is externalized and the type of management that is internalized is often different. It is often a function of either access or expertise, and sometimes it's a function of just wanting external, for the larger funds, wanting external access to the market to see what's going on. So I think it's an excellent question. I don't think that even if we had the data, I'm not sure the answer would reveal what we think it actually reveals, because there isn't a level playing field.
Right. Of course, it comes down to...
I have a comment on that, if it's helpful. Calpers is about 80% internally managed, and that's probably at the high end. But I think what this is touching on is a bigger question about governance of the pension retirement savings industry all over, because it's quite clear that the internal management model is cheaper, dramatically so. So that's one advantage, but there's another question, which is alignment of interest. And there's a moving I think, a moving agenda here where asset owners are becoming more articulate about what they need from their managers. And you see groups like the International Corporate Governance Network, the Principles for Responsible Investors, providing model mandates so that asset owners demand more of their asset managers. So that, you know, for example, proxy voting, it's often commented, how does a fund manager end up deciding to vote in a particular way on a climate change proposal, for example? How is there accountability to the customer? That's one element of the governance conundrum. And I would say on this question about costs and governance, you might take a look at some of the research from Boston College in the United States, because they have looked at this, which is very interesting. And we benchmark ourselves on costs, performance, and all that jazz against a peer universe of funds to try and keep track of these issues so we can be as efficient as possible for our members. And we benchmark ourselves through a project called CEM, which is a comparative economic data to compare this. So that might be something be good to connect in with this discussion. But that then leads me to worry about the way that we are failing to design vehicles to ensure accountability with the pool of savings, which is not in, as I think it was Robert put it very nicely, as in the stock of savings, it's the flows of savings. Because if you take a pension fund like Calpers, obviously we're all wrapped up in fiduciary duty, as we should be, and like the rest of us in the industry. But half of our board is elected. Half of our board is appointed by various representatives of the taxpayer who bear the risk. Our meetings are in public. Now, that's sometimes good and it's sometimes really tough. But we are held accountable for the decisions that we make, and our beneficiaries have an opportunity to have their voice heard. Now, if you go and buy an individual savings vehicle, of, whether it's a 401k in the United States or a target date fund somewhere in Asia, the question is, who's going to ensure that there's accountability on the part of those who then receive the money? And we've got to start thinking more carefully about the impact with the increase in fees, the fragmentation of risk, the inability to pool assets for the long term. That may well pose some serious challenges for capital formation in the economy, but I also worry about how we're going to get some accountability, some execution of fiduciary duty, not just something in law. So I think as there is this transformation in savings, which is quite rightly being observed and commented upon, I think these governance questions have got to be put on the table as well. And we've actually got to think about how we're going to ensure that we have appropriate governance models to ensure that transparency and accountability for these, rivulets of savings, because it's still ordinary working people's money from around the world. And how it's taken care of and what it costs and where it goes and what's done with it is equally important to them as it might be to, say, a beneficiary in a Calpers style pension fund. I also want to just to somewhat disagree with a comment that Europe is ahead on ESG issues. Now, obviously, I'm European, I'm British, but I'm very struck in the United States that the public pension funds, I mean, Calpers, obviously, the second biggest fund, CalSTRS, it has got an absolutely extraordinary program in this arena. Likewise, UC Regents, the University of California funds, is third biggest in California. But then I can list New York State, New York City, Washington State, Oregon, Florida, all of which probably some 30 years ago came together to form their very own body, the Council of Institutional Investors, which has really been a wonderful champion for improving governance in the United States. So they started off without the shareholder rights that are taken for granted in Europe. When I first joined Calpers just over 10 years ago, I was surprised to see that you didn't, as a matter of routine, when you were voting on corporate boards, you could vote yes, but you couldn't vote no.
Mhm.
So majority voting was the first thing, that the public pension funds working with the Taft-Hartley funds and others had to work really hard to put in place company by company. And because it's all governed in state law, you haven't kind of got the federal body that can go and fight those battles for you. So it's always a question of where are you now, but the question is, where did you come from? So I think making comparisons across regions has to be put into that context. And I would say the same in Asia as well. There is some extraordinary work being done in Asia. Climate Action 100 Plus has an Asia advisory group, which includes many of the most significant and influential funds in the region, both fund managers like Cathay Holdings and asset owners like GPIF. And again, they are building an approach which is really very impressive and having some significant impact. So I think regional comparisons can be invidious.
Mhm.
So that's just my other.
Thank you for
comment.
that. Thank you, Anne. I want to, so there's so many things I want to come back to, including things raised by Anne, and come back to you, Robert, and also Andy in response to what some of the points that she made. But Deep, let's get to you and hear what you have to say. Just in terms of everything that you've heard, are you still with us, Deep? There you are. You went on pause there for a moment, but just
yes,
yeah, take us full circle, if you will, and comment. We started talking about the challenges for pension funds, and Anne has raised the question of accountability, the transformation that's happening in Asia toward more private investment, toward more investment, and the challenges that are involved having to do with accountability.
And in the United States as well. It's not just Asia.
Right. Thank you. So Deep, just bring us full circle, if you would, on the conversation, both in terms of the challenges as laid out in the report, but also some of these issues that Anne is putting on the table for us.
Sure. Thank you, Marsha. You introduced me with two hats on. One is the academic hat, and the other is an asset owner hat. Before I retired from other things and put on these two hats, I spent, between getting my PhD and becoming a professor at a university was a 28-year gap, which was pretty much all of it in the investment business as a hands-on investor. So I still have that investment strategy, money management, bias to how I look at the world, and any comments that I make is sort of grounded on that. And I have in my career, which was sort of half on the buy side in and around prop trading, and half on the half on the sell side in and around prop trading and strategy, and half on the buy side where I've done various things, including buying meaningful positions in mid-sized companies in Asia and trying to work constructively with company management to improve ESG and other ways of unlocking shareholder value. So I've sort of come a full circle with some of these things as well. And so I have 5 quick observations, and if there is time, we can dig into them in some detail. I'm conscious of the fact that we are running out of time. One is, I am possibly at the more pessimistic end when it comes to taking a stab at guessing what the investment return landscape might look like over the next 5 to 10 years. And I know all of us in the asset owner business would love a 5% real rate of return, because that would be wonderful for our members. But I cannot put my hand on my heart and say that is actually achievable. I think 3% is a more realistic number given the environment that we are in. And even getting to 3% is going to require possibly active management, illiquids, some use of non-recourse leverage if it is possible to get that. So that's one observation. The second point that I would make is, I meet so many people in the business, and everybody tells me it's a really bad idea to own government bonds and high-grade bonds, and we should put it all in private equity or infrastructure, etc., etc. And I personally think that's a terrible idea. I think abandoning high-grade bonds for the unknown and dialing up the risk profile, which everybody seems to be wanting to do, is a seriously bad idea. I think high-grade bonds are needed for safety, liquidity, protection. Sadly, we now have to pay for those things in the form of foregone, nice possible returns in other areas of the market. And as Mark Burgess mentioned in the beginning, 35 years ago when he started in the business, real returns were very, very good in the bond market. We don't have it anymore. But I grew up in Asia, and I've read Zen Buddhist literature. We have to accept reality. So we have to pay for protection. There's nothing we can do about it. It is what it is. Maybe there is a case for owning inflation index bonds in the portfolio as opposed to just nominals and not be hamstrung by benchmarks, but giving up on that, and the COVID-19 crisis proved, at least in Australia, where we had to give some money back to members for government regulation. I think having that is important. So let's not just throw it out. The third point that I would make is that this enthusiasm for illiquid assets is not necessarily a solution for everyone. There's interesting research coming out in the Journal of Portfolio Management recently, which looks at, who's benefited from investing in illiquid assets within the so-called long-term investor community. And you would be surprised. Most have not, a handful have. And I think the next 10 years will be even more difficult to extract that complexity and illiquidity premium from private equity, property, and infrastructure for the simple reason that two reasons. One is there'll be intense competition for these assets, even more than what we have seen in the last 10 years. And a lot of skill is going to be required to extract those premiums. Not everybody has that set of skills. That skill is scarce in the community. And, there will be a whole range of asset owners who 10 years from now will look back on their record in illiquids and say, we were tourists there and the locals took all the premium. So one needs to be somewhat conscious that just because an asset is illiquid doesn't mean if we invest in it, wow, we make a 5% real rate of return. That's probably not going to happen. The fourth point that I would make is that the fourth industrial revolution and its implications are still not well understood in the investor community. Now, I've been dabbling in that area since early 1990 when I worked with a bunch of investors, former colleagues of mine, trying to use AI and machine learning in the investment area. So I've been following that space. I think we are at the very early stages. And we could have a separate session on that. That's not the point. But I think the fourth industrial revolution is disrupting business in a way, companies in a way that is not well understood by the investor community. And I think one of the reasons why traditional active management, which I also learned my stock analysis from a book published in 1934, Ben Graham, and everybody is trying to take a stab at forecasting balance sheet and income statements the next 30 years and discounting that back. It has become very hard. When I was picking stocks, I used to go visit a company and try to get a meeting with the CEO and the CFO. Never thought about meeting the CTO. And an informal poll of stock analysts that I did recently, nothing has changed. People are still trying to understand how a company would perform, not taking into account adequately what AI and machine learning and the adoption of the fourth thing, as the fourth IR spreads, what it is going to do to these business models. It may be one reason why value investors are not beating value indices, and even growth investors, some of them are not beating growth indices.
So Deep, if I can just interrupt you before you
Sure.
hit your fifth point, could you talk a little bit about your fund, the Retail Employees Superannuation Fund? Is it mostly internally managed or are it externally managed? What are you doing on asset allocation and what are you doing on risk in the face of the current circumstances? Could you speak to that?
I think REST, we have 2 million members. It's managed like most other public pension funds. It's a mix of liquids and illiquids. It's a mix of external and internal. The core portfolio is a blend. It's a blended approach, a diversified long-term portfolio. So we look just like anyone else in the asset owner community. And there are of course portfolios that have different risk profiles depending on what the investor wishes. They can go and they have the choice. So there's not one single portfolio that is imposed on everyone.
Okay.
So if you're closer to retirement, you have the option of dialing down. So we don't have a target date type approach, which Andy mentioned, which some of the other public pensions in Australia have adopted. We don't have that, but it is possible with the help of financial advice from REST's advisors for an individual to slot himself or herself into a strategy that is appropriate for their needs.
I see. So I'd be curious where REST stands, where GPF stands, as this transformation is taking place, and as this third pillar that Andy talked about, and the World Bank originally talked about, but that Andy raised, the third pillar gets more attention in Asia, parts of Asia. Are you finding you've got sufficient voter education, that you've got sufficient voter education, people who can raise some of the questions that Anne was raising about accountability and carefulness in terms of the investment? What is happening at GPF, Dr. Mann?
Yes, about financial literacy, I think it's our duty to give them a knowledge from the beginning to the retirement. But we find out that the behavior is they are so initiate. They listen, but they don't choose the appropriate choice. So right now we try to invent a simulation tool for them to compare their current plan and the risky plan and low risky plan for them to compare from time to time. And so when they see the difference between the risky and less risky one, so they can choose the right one. That's a tool that we try to invent. But the rest that we're not sure that they're gonna change the plan or not, we try to have a life cycle plan as a default. And now it's still an alternative choice. But we think that we try to convince Minister of Finance to allow us to be a default plan, yeah, for the member who haven't choose any plan.
Okay. Andy, we've got a question directed at you in the chat box, and it's asking about China and Pillar 2, and asking if China might be an exception to your comment that Pillar 2 is not fertile ground in Asia, so to speak.
Yeah, so well done somebody for kind of calling out my overgeneralization of a heterogeneous Asia. So yeah, I mean, I think China does have potential for Pillar 2, and in fact there are corporate DC plans at the moment, especially from the SOEs, although they tend to be managed a little bit like DB plans in some ways. So not, dare I say, early in the evolution of thinking about how to deliver an appropriate stream of investment results to an individual investor in a DC structure. So does China Pillar 2 have potential? Yeah, absolutely it does. But I also think that I think that it's going to be quite slow to develop. But yeah, good. I mean, good for China if they do put more encouragement in place for Pillar 2 to work. I think the ideal world is one where you have all three pillars functioning quite nicely.
Okay, terrific. So, Anne, I wonder if you might tee up again the question for us that you raised having to do with corporate governance. I don't think we'll go to the competition between Europe and US on ESG, but if you might tee up that question, GPF has got a long tradition in corporate governance as a pension fund. REST, I'm guessing, also has some accolades in that direction, and our other two panelists may have comments. But if you tee that up, you made a very fine point having to do with corporate governance, and I wanted to bring it back to the rest of the panelists. Would you mind doing that for us, please? Oh, I think you're on mute, Anne. You're on mute. You're still on mute. You're still on mute. You're still on mute. Well, let's come back to that. Maybe the technical people.
Yeah, sorry, Martha. The message I had was that the organizer had muted me, so that meant somebody on your side had to do it. But no, let's go straight to the panel. I think the point's made, and everybody will have an interesting comment to make.
Okay.
I don't want to repeat things.
Maybe you couldn't hear me. I was asking if you would tee up your point about corporate governance that you made in the last in your last interjection. I'm not going to do it justice, so I wanted you to go ahead and tee it up.
You mean about investor governance?
Correct.
Or about investor governance, not corporate governance. Yeah, so I was saying that we've learned a lot in our investment processes that, and this is true in private markets, this is true in private equity as it is in public equity, that the governance arrangements have a huge impact on performance. You know, there's even interesting work that's been done using governance as a way to explain why private equity, it's not just an illiquidity premium, but that there are operational improvements which come once you don't have that sort of dispersed ownership and churn on your share register, that there are real genuine benefits to the oversight that can be brought, and the professional board that can be brought in to a company. So leave that aside. I think in most areas of study, and including the Boston College study, which I mentioned, there is evidence that governance matters to pension fund performance as well. So I think a new area for all of us to think about is, as the nature of savings are transformed through secular changes in the economy, which I know Professor Kapoor is a pessimist, I'm an optimist, because I actually see, certainly we see in our portfolio, huge opportunities. Maybe it's because of our location in California, which is, you know, obviously such a technology hub internationally, such a, you know, center for innovation. Maybe it's location, again, that matters. But we see the opportunity in all of this, as well as the risks that need to be addressed. But as we're transforming our financial service sector in this way on the savings end, I think we need to begin to work out how we're going to ensure frameworks for transparency, to allow for accountability to the people on whose behalf we are investing. And a pension fund or a government pension fund has got one or other of these governance models, either through the political system of accountability, through the government ministry, or, you know, in the Calpers style model, where we have both appointed and elected trustees. So the question is how, if individuals are handing over money to intermediaries, this seems to me we have a governance vacuum at the moment. And I don't know that regulators can step in and do the job entirely. You know, rules on fiduciary duty obviously exist, and best advice and so forth. But I actually think we've got to be more imaginative and think about how we're going to ensure that there is accountability to savers, because that's actually going to be extremely important to increasing savings rates. People will not hand over their money and save at the rate that's needed for their own lengthening lifespan and for the capital formation that the economy needs if there isn't that high degree of trust. So that trust will be a byproduct of getting this right, but I also would venture that it will probably improve performance as well, because we've seen that on the governance improvements, you know, for ourselves, both in public and private markets with corporations and with other organizations as well. So that, sorry to repeat the point, but I think that was the point.
Thank you. Rob, we've got just a couple minutes, 1 minute, and I think we've lost Andy. He had his hard stop right about now. Robert, let's come to you and answer. Have you picked up on questions in your survey that you do? And are you picking up questions around the investor governance, and accountability? Are people raising that in terms of what they're on the lookout for?
I think it's an absolutely crucial issue, and I'd endorse everything that Anne said. Interestingly, no, but I don't think that is necessarily reflective of the whether it's being considered. I think that's probably more reflective of the level and the type of conversations that we've had. So we'll go out and find out, and we'll have another set of conversations. I'll be more surprised if those considerations aren't being thought about. However, what I would say is that I think the recognition of the importance of governance is really a measure of the sort of sophistication and maturity of the investors. And I think a lot of the returns and a lot of the output and a lot of the success of the biggest and most successful investors comes down to governance. And I think that's a fact that's not widely recognized. And I think some of the smaller or less mature investors and funds, it probably isn't on their agenda to the same extent because they haven't got to that stage yet, I suspect. Okay,
great, very well said. I'm going to just take the liberty of the chair here and Deep give you a final word. You had a fifth point, I believe. So very briefly, because we're right at the bottom of the half hour, and I think we're due to all sign off. So very briefly, your fifth point, and then we'll wrap up. Oh, he needs someone is muted. Deep. Please unmute him. Can the organizers please unmute Deep? Hello?
Okay, I seem to be on. Can you hear me?
There we go. Very quickly, Deep. Very quickly.
Very quickly, yes. I think the final point that I wanted to make is that this COVID-19 has illustrated the need for asset owners to focus more intensely on extreme but plausible scenarios. And you know, this has ramifications for how you think about ESG. It has ramifications for us in Australia about how much of our assets we want invested in Australia. We are a small country, 2% of the global equity market, yet most pension plans have 25 in Australian equities. So the risk management function within pension funds, I think some have that elevated at a very high level. In some others that I observe, it's sort of buried under various other structures. They do not have the ability to raise red flags or discuss important matters that need to be discussed. So I think that risk management, you know, as in a hedge fund, the risk manager is as important as the CIO. That's not the case in the asset owner community. I think that needs to be something worth focusing on.
All right, terrific. Terrific. Listen, I want to thank each and every one of you for your wonderful contributions, your insightful contributions. I think we barely scratched the surface of this discussion. I hope you will all come back and we'll pick up the conversation again. I'd be remiss as an advisor to OMFIF not to thank the two of the sponsors, to Citi and to Capital Group. And thank the organizers for such a well-organized program as well. Thank you to the staff. I was asked to tell the audience that there will be a corrected copy of the presentation online on the OMFIF website. There was a glitch and an error, and they wanted to correct that, and that will be posted. So with that, I'll wish you all a good evening, a good day, and please stay well and stay healthy.
Thanks, everyone. Thanks, Marsha. Bye.
Thank you. Thank you, everybody.
Bye.